today is the Fed's day, but Brian, it's really not about the Fed. I think markets know, bond investors know that we're looking at normalization, but at a very slow pace, 25 basis points perhaps per year. Why does that affect the stock market, and why does that affect high yield bonds like it's doing at the moment? You know, we're in an earnings recession and have been for 5 quarters, and the fact is, sound like a politician here, but the fact is that 1 to 2% real GDP growth and near 0% interest rates, which lowers margins for financial companies, basically doesn't produce much in terms of earnings growth. And so those are the considerations to look at going forward. Can the economy grow faster than 2%? Yeah, perhaps the election says something about that. But basically, the Fed has already admitted that productivity is 0 to 1%, and the labor force is growing at 0.5%. And we're stuck in this 0 to 2% rut, and it's not good for financial assets, which have been overpriced for 5 to 6 years.
You know, so if the Fed is sort of lurching toward irrelevancy, at least in the near term, Bill, what does matter now? Is it that lack of growth? Is it politics? Is it something else?
Well, lots of things matter. I mean, real growth does matter. It would be nice to have 2 to 3% real growth in the United States. I don't think it's going to happen. Inflation does matter to the extent that it moves up towards 2%. That's a bond negative, and perhaps not so negative for stocks. But you know, the things that matter are really structural, and they don't take up headlines, and they don't make for, you know, interesting conversation, I guess, on TV. But there are structural problems such as demographics and high debt levels and leverage in China, for instance. There are technology displacements of labor, deglobalization, as we've seen in Brexit.
Bill,